Joining me now to talk more about the economy, of course, the impact that markets is having too, is David Seif. He is the chief economist at NYSE listed firm Nomura. David, welcome.
Thank you. Great to be here.
Great to have you here at the stock exchange. A lot to digest of late. Investors certainly taking it in stride. What do you make of the inflation data today?
Yeah, so the inflation data was a little softer than expected. Always great to see a soft print when inflation is above target to begin with, and especially going into what may be tariff-induced inflation. I will say, however, that we really didn't expect the April numbers, which were released today, to have too much of a tariff impact in there. So what it shows us, and I think also what the previous month, which was also below expectations, showed us, is that things were set up pretty well going into the tariffs. And so we're starting from a better base. But it's really May, this month, which we'll see the data for next month, where we expect to see tariff-induced inflation, if it comes, start to really manifest itself.
Interesting. And how do you expect the tariff-induced inflation to change these numbers?
Yeah, so we see year-over-year inflation rising significantly from where it was, where it is right now. And so we think that inflation already is above target and probably going to rise another roughly 0.75% from where it is right now to be well above the Fed's 2% target. The Fed looks at core PCE, that's at 2.6% right now. We think that's going to get to about 3.3%.
And what does that mean for the economy?
Well, we think that the tariffs in general mean that we'll have below trend growth. We don't think that we're going to have a recession, but we do think that it will be significantly slower growth for 2025 than we otherwise would have had. It also really puts a freeze on the Fed because the Fed gets pulled in two different directions. On the one hand, it wants to ease because growth is lower than it should be. But on the other hand, it needs to sort of keep the brakes on things, keep rates high because inflation is higher than it wants it to be. And we think that the Fed has really communicated that unless there's a real meltdown in the economy, it's going to prioritize inflation, keep rates steady, and we don't envision the first cut until December, or the next cut until December of this year.
Interesting. That could have an impact on stocks. We know historically investors and traders do like lower interest rates, but I do want to talk about the Fed's dual mandate because, as you referenced, inflation is one key part. The other part is jobs. And so tariffs, inflation, of course, the Fed, how do you see that impacting the jobs market?
Yeah, so we think that the below trend growth that we're going to see certainly won't be great for the jobs market, but it's not going to cause a real spike in the unemployment rate that would be characteristic of a recession. And we think this is really what's key for the Fed. We could easily see the current 4.2% unemployment rate creeping up over the course of the year by a few tenths of a percent, but that's probably not going to be enough in the face of higher than target inflation for the Fed to cut. Now, if it's worse than we think, if this is a full-blown recession and the unemployment rate spikes into the 5s, into the 6s, then of course all bets are off. But we think that it's going to be strong enough, not strong, but jobs are going to be strong enough that the Fed won't feel compelled to cut because of the inflation.
Do you think December is the right time to cut?
We think that based on our forecasts that tariff-induced inflation will really have faded or have begun to fade pretty clearly by December, and that should give the Fed enough cover to cut. I think what the Fed wants to make sure is that a one-time inflation burst due to tariffs doesn't do sort of what the post-COVID inflation did, spread into services, spread and become more entrenched. And it wants to wait until those monthly inflation numbers, or we've had a couple of better prints than what we think we're going to get before it resumes cutting. And I think December's probably going to give it the cover it needs to do it.
What is your GDP growth expectation for the quarters ahead?
So our thought is that on a Q4 over Q4 basis for all of 2025, we're going to have just 0.8% growth. And that's even taking into account the positive tariff developments yesterday. So that's well below what we think is slightly above 2% trend growth for the economy. It will feel not so great to the average consumer, especially in the face of what we see as some rising prices. But it's not sufficiently bad to really be a recession where lots of people are losing their jobs.
Is the case that the president is making that tariffs will help the U.S. over time true based on your economic models?
Our thought is that it's not really going to help the overall growth. Now, I think that the president's case is that this will help some of the distributional effects and onshore or re-onshore some industries that are critical for the U.S. And that is certainly a political decision, and one can use one's own judgment on that. In terms of the actual raw data that we see in terms of economic growth, we don't think that this is going to increase economic growth over the long run. It's not going to be terrible for economic growth either. It's going to be a fairly weak 2025, and then returning to a growth trend approximately where we were, but with an economy that looks a little bit different because tariffs are now at their highest level since pre-World War II, and we think they're going to stay there.
Do you think that economies around the world are in any different shape based on this trade war?
Yeah, I think all economies need to adjust to the fact that their trade with the U.S. is probably going to be impacted. And the more countries trade with the U.S., the bigger that impact will be. I think the impact is far larger on the United States, however, than on any other economy. And that's really the key thing. We're doing something that disrupts our trade with every single one of our trading partners, so to speak. And every other country is only getting disrupted with a single partner, the United States. Now, it's a big partner, of course, but it's the U.S. that has 70-odd trade deals that it's trying to strike, and every other country is trying to strike a single trade deal. And so that's the situation we face ourselves.
David, quickly, it just seems like, based on your projections, that as prices rise, consumers will pull back spending. Is that your expectation?
Certainly, real spending should be hit a little bit. We don't see it really collapsing, but we do think that people are going to have roughly the same number of dollars, but with prices higher, that's going to be able to buy fewer goods. And so real spending, as we measure it, will probably grow less than it otherwise would have.
All right, David Seif, he's a chief economist at Nomura, joining us in studio. David, thank you.
My pleasure.
Yeah.